Good afternoon, Alex Cole, my friend. Welcome to the GoNoGo Charts show here on September 29th, 2022. How are you today?
I'm okay. How are you?
I'm doing just fine. Certainly the news headlines from around the world, what's happening in Europe, hurricanes in the Gulf. There's plenty to discuss, and the markets are digesting a lot. So let's dive right into our GoNoGo cross-asset heat map. Let's take a look at what's happening from the major trends across the world.
It's not a good picture, and it hasn't been for a few weeks now. But as you can see, we are in some strong no-go trends for 3 of the 4 asset classes. So, of course, the top panel is equities. We're seeing that strong purple no-go uninterrupted now for a couple of weeks. Treasury bond prices in the second panel in a strong no-go. Remember, those move inversely to rates. So rates are, of course, moving higher. Commodities in the third panel have joined the strong no-go that we see in the top 2 panels. And then down the bottom, the lone standout is the dollar. It has weakened a little bit. We've seen it come back yesterday and today, painting a paler aqua bar, but still the only go trend as we look around the asset classes.
Absolutely, Alex. Let's dive into the price action of the S&P 500 for all of our listeners allocating to US equities. Let's take a look at what we're seeing from a price action perspective. Yesterday, obviously, a very strong day. All 11 sectors of the index up. People speculating around the 5% gain or near 5% gain in crude oil yesterday. What I'm seeing from that remarkable relief rally is really just still a long-term no-go trend here on the daily chart. What are you looking at from a trend perspective on this chart here, Alex?
I think that what we always have to do, because we talk to so many different people in different areas of the business, is just try to help people keep things in perspective. And a one-day move like we saw yesterday can't really do as much to change the trend as people might think when you're living through it. So yesterday felt really strong and a really, really good day in terms of a bounce. But really, like you said, when you look at it in the context of the trend, you don't even really see it jump off the chart. And today, of course, we are back down lower than where we opened yesterday. So this no-go trend seems to be strong. We're seeing strong purple bars. The oscillator is in negative territory, still not close to testing the zero line, and volume is heavy. So there's a lot of evidence here saying that this is a no-go trend, and yesterday was just a move in a no-go trend. Tyler, I think you're on mute. If you wanted to just click on that button.
Sorry about that, my friend.
All right.
So for all of our listeners, we're not dictating what your time horizon needs to be. For many participants in this market, they're looking at much shorter term trends. So Alex, let's take a look at the S&P 500 on a 15-minute bar. So if you are an intraday trader and you're looking to capture upside on these high volatility moves, there we see yesterday the entrance into a go trend. Certainly, the dangers of trading to the upside in a downward trending market means that we do tend to have these higher volatility moves as it mean reverts. And the gap lower today certainly not favorable to those leaning into bullish positions. But Alex, what really jumps off the page to me is just the oscillator's performance on this very short-term view. Talk to us a little bit about what's built into the GoNoGo oscillator, what we're looking for in terms of a momentum and trend interplay.
Yeah, and I think to the point about everybody's time horizon being different, if you are really trading yesterday's price action, you're trading a very fast chart and you probably aren't holding positions overnight. And that would have been what would have got you this morning with that gap down. But you do see snaps back to trend very strongly like this, as you highlighted with that gap down. But in terms of the oscillator, just to remind everybody, when it's a blend of some of the most robust momentum tools into one oscillator panel, so you don't need to overcrowd your chart with multiple panels. And when it goes from the paler aqua blue color to a dark blue, that tells us that we've got heavier than average volume. So this return to the no-go coming with a return to heavy volume is also quite significant in this shorter time frame chart. The other thing we want to point out is that we need to see momentum stay on the side of the trend for that trend to be healthy. When we are in a no-go as we are now, we will look to the oscillator to see if it gets rejected by the zero line and stays in negative territory. That's what we would expect, all else being equal. You can see that it's riding the zero line now for several of these 15-minute bars, and the GoNoGo squeeze grid climbs. But we're going to watch to see if this breaks back down into negative territory. Expect more price action to the downside.
Absolutely. So the multiple time frame perspectives that that you and I were taught by CMT Association members and great analysts and money managers around the world suggest that we have to keep in mind the primary trend of the market. So we were looking at a daily. This was an intraday 15-minute chart. Alex, let's bounce this out to a weekly time frame and just the prevalence of lower highs and lower lows when we step out to this long-term horizon. The entire year 2022 has been in a largely no-go trend environment. Talk to us about what you'd need to see on a weekly basis to tell us that the low is in fact in, and we're reversing back to a long-term uptrend.
Well, what we'll need to see is a break of the oscillator back above zero and then support found above the zero line. You can see that the summer move was a strong rally, and it pushed these no-go bars into consecutive weaker pink bars, and people were getting excited, and the oscillator actually did dip itself into positive territory. But then as it came back to zero, we were very concerned to see whether or not it would hold, which might well have sent us higher, but it didn't, and it went straight back to negative territory. And we've actually got therefore a no-go trend continuation icon, that red circle, telling us that momentum has returned in the direction of the no-go trend. So as you can see now, we're trying to test and set new lower lows, as we've been seeing all year, lower highs and lower lows. Interestingly, the oscillator did what we thought it would and acted appropriately when we were in the go trend. When it broke below zero, that gave us that warning that it was unable to get back into positive territory, and that told us that this no-go trend was now the prevailing trend. That didn't happen this time. By breaking into positive territory, it went back into negative territory. So it looks as if we are still in a no-go on the longer time frame, with momentum confirming as it's under the zero line.
Absolutely. So with these relief rallies, we know that they can be very seductive, but also sometimes short-lived. So set your stops, control your risk, and if you are a long-only person, stay out of those no-go trends. Alex, let's switch our view to some of the macro drivers for this heaviness and further weakness in the US equity markets. Let's take a look at Treasury yields, again, moving inversely to the bond prices. US Treasury yields back in a strong go trend. Here we are on the, is this the daily or the weekly?
Daily.
There we go. Perfect.
Yep.
Talk to us about what's happening in the TNX, the 10-year Treasury yield.
Yeah. So what we saw this week was a new high being set. We saw it consolidate a little bit at the prior high from earlier in the year, break above that, and then a new high set the beginning of the week. And we can see this red triangle. This is a counter trend correction arrow within a go trend. So telling us that we may in the short term come back a little bit. And that's because the oscillator momentum has gone from being overbought back into neutral territory. But it does not mean by any stretch of the imagination that the go trend's over. We're going to look to see what happens if the oscillator approaches zero, whether or not we find support, as we would expect if this trend is to continue to be strong.
Absolutely. Our good friend Walter Deemer, former president of the CMT Association and great technician, said that rule number 4 from Bob Farrell was that parabolic moves tend not to resolve in a sideways consolidation, but they can last longer than most folks are prepared for. So speaking of parabolic moves, Alex, let's take a look at the US dollar chart, another one of those major headwinds for risk assets and for US equities generally. A lot of speculation, a lot of discussion amongst research analysts about that parabolic move. And yesterday, certainly a very heavy day for the US dollar. What are you seeing from a trend perspective, Alex?
Well, in a trend, when you're looking at something from a trend perspective and you're seeing a trend in place, we know that nothing moves in a straight line and that the trend will move in waves. And what we saw over the last couple of weeks was another one of those waves higher, as we saw a new high be set. And now we are correcting against that move higher, but just a bit like the treasury rate chart, sorry, but perhaps more pronounced. Still in a strong go trend. This cooling off here was somewhat to be expected given the parabolic move, but we are still in positive territory, and we're going to see if the oscillator finds support at the zero line. And if it does, then we'll most likely have set a higher low. So as long as we are supported by the zero line, there's no reason to believe that this is not just a new higher high in an uptrend.
And all else being equal, we're going to keep our eye on the weight of the evidence. We want to make sure that we're disciplined in our investing process. So the checklist that GoNoGo Charts provides looks at across the realm of technical indicators for trend. We can see that the overall technical conditions for the US dollar are still in strong go conditions, meaning the weight of the evidence is to the upside until proven otherwise. I do see heavy volume on yesterday's selling, but the oscillator still hasn't even reached neutral or zero. So with this chart, we got to assume that there's further upside and just react responsibly to changes that we might see, starting with the momentum oscillator. So Alex, let's turn away from the US dollar. Let's pull up a chart of oil. Yesterday, big move higher, about 5% in crude. What are you seeing from the U.S. oil fund with that major relief rally yesterday in terms of the longer-term trend perspective on this daily chart?
Much like what we were saying about the equity chart, the S&P, yes, it was a very strong move high yesterday, but still lower than these recent lower highs. So really any kind of downside movements now will be setting a lower high. So like you said, you've got to be very careful with relief rallies. It was a very encouraging and exciting day yesterday, but today we are getting closer to the zero line. We do see a pink bar, which means that no-go has weakened. But if we stay below zero, then we are looking at the no-go trend most likely continuing. Interestingly, I don't know where we'll end up today, but I wouldn't be at all surprised if this ends up as a bit of a doji. That would suggest uncertainty with the open and the close price very close together. We could end up there, or we could end up, of course, higher, or we could end up coming back lower than yesterday's close. So it'll be interesting to see how this bar closes. Right now, it's showing a bit of uncertainty. We've obviously moved up a bit, we moved down, and we're back to just about where we opened.
Absolutely. When we started today's show, we were looking across the asset classes and commodities generally out of their go trend that was persistent through 2021 and in the first part of this year. Alex, let's pull up a chart, DBA, which is a diversified agricultural commodities ETF. And just outside of industrial materials or precious minerals or the oil and energy sector, let's take a look at what's happening from a trend perspective in agricultural commodities.
Yeah, DBA is an interesting fund. There's a lot of variety in there. We've discussed before the components of DBA, but as a fund that represents a wider spectrum of commodities, especially agricultural ones, you can see that it tried to trend, it tried to go, but we've fallen back into a no-go with the oscillator back below zero. So this is a good example of using the trend and the oscillator together to try to understand what's happening. And you can see how here, when we were in this no-go move, oscillator below zero, once it broke above zero, we saw some uncertainty and some inability of the trend indicator to maintain one trend in terms of colors. When the oscillator then was supported by the zero line, that's where we went into the go trend, and we stayed there, albeit moving sideways primarily for several weeks. But as long as the support was found at zero, then the sort of the weight of the evidence suggests this go trend is okay. But as soon as that breakdown happened here on the oscillator, then we are able to see that we've fallen now into a no-go again.
Absolutely. So being here at the near the end of the week, near the end of the month, and therefore near the end of the quarter, let's pull this out to a very long-term chart, starting with the weekly, and then we'll move to a monthly view. I think with a lot of our institutional clients, financial advisors, and asset allocators, thinking about what materials or what securities are going to be favorable during a recessionary economy or a inflationary economy. We certainly see a lot of allocators looking outside of traditional allocations in growth equities. And for those who are index holders, we know that the market cap weighting really leans into information technology and long duration equities here in the United States. So when we see this on a weekly basis, it certainly has held up better than the rest of the equity markets have through this sharper no-go trend. Alex, I'm seeing a build of the squeeze on the far right side of this chart as we've got narrower range in price action. Talk to us a little bit about what that squeeze indicator is telling us.
Yes, and to your point about the allocation of money elsewhere, commodities has been something that we know our colleagues and people in the industry have been talking about as a possible super bull cycle for many, many years to come. So if this is just a correction against that, then people will be watching very, very closely to see what happens in the next couple of months with something like this. And what we're seeing here on the right, what you alluded to, is the GoNoGo squeeze grid climbing for every bar that the oscillator remains at the zero line. And as you said, that's because of this reduced volatility, prices shrinking and moving sideways, meaning that we don't have much directional momentum, at least for the last 4 or 5 weeks. We've been stuck at the zero line. And we know that, like, squeezing a tube of toothpaste until the top blows off, we know that out of this kind of reduced volatility can come significant moves. So we'll be watching very closely. Will this find resistance at zero, break back into negative territory, in which case then we would expect price to try to set a new low? Or will we break out of the squeeze into positive territory, and then we could look for price to return to its longer term go trend?
Absolutely. And if we could just bounce this out to a monthly trend to give us that very long-term view, we had a decade-long downtrend in agriculture and commodities generally as things were unwinding from peaks in 2009 and 2010. And so here we were, that COVID crash in 2020. We've just had a strong run in all diversified commodities out of those COVID lows. So on a monthly basis, we are consolidating within trend, and I see that oscillator at the zero line starting to build a squeeze. But we'll see how things play out over the coming months and whether or not this would be an opportunity to get into a very long-term trend. Again, we're talking about here an allocation perspective. If you're thinking about pension funds, sovereign wealth funds, folks who are looking on very long time horizons for where they're allocating large pools of institutional capital. Just good to keep in mind what that primary trend is telling us. Absolutely. Alex, moving on from all the discussion on these macro drivers, let's switch gears and look at the GoNoGo Sector RelMap. So we're going to get under the hood of the S&P 500 index. We're going to take a look at sector performance, not just on an absolute basis, but on a relative perspective. So how are the sectors performing against the benchmark? And so if we're doing some tactical asset allocation, we're thinking about what sectors of the market we want to be leaning into. We certainly want to choose those with strong relative performance relative to the benchmark. Let's talk through all the sectors of the S&P, Alex. What's new?
Not a lot.
We've been in this kind of map for many weeks now, haven't we?
Yeah, we've seen this shift to a more defensive picture for several weeks. The latest to fall victim to the no-go trends are industrials and materials. That's these two here towards the middle bottom of the chart. And then what you're really left with in terms of relative outperformance are the defensive sectors that you expect: utilities, staples, and healthcare. And then interestingly, financials is maintaining a weaker go trend, and so is energy on a relative basis. You were just talking about how relative to the moves down in the S&P, commodities have held their own a little bit better. Well, we can see that relative outperformance here in energy. And the one that continues to perhaps confuse and amaze is the discretionary sector holding on to its relative outperformance. One of the growth sectors that hasn't given in yet anyway, like technology and communications have, to these no-go trends that are helping bring the market lower.
Absolutely. So let's dive into that consumer discretionary sector. Again, outperforming on a relative basis, but as we all know, relative performance does not mean that it's in an uptrend. It just means that it's going down less than
Correct.
the benchmark index. Which, for institutional managers, if the market's down 30% and they've been able to hold in single digits drawdowns, that's a win. So let's talk a little bit about what's happening on an absolute basis for the consumer discretionary sector.
Yeah, I mean, it's a similar looking chart to the S&P as a whole, but you can see how this no-go trend is more recent and less pronounced.
Mhm.
But you can see that the oscillator broke below the zero while we were in this attempt at a go trend. That gave us cause to worry about its health. Then we see the no-go oscillator staying below and getting rejected out of this max go no-go squeeze back into negative territory on heavy volume. We aren't by any stretch of the imagination saying that this is a buy opportunity, let's say, but as you said, going down less than your benchmark is certainly a win for money managers.
And Alex, if we could just annotate what looks to be a horizontal level of support back from what was resistance in June and July, it seems that price hasn't quite broken through that floor yet here in the end of September. And again,
Yeah,
we're looking at this on a daily basis, everyone. So not our very long-term perspective, but certainly for the intermediate term, what seems to be holding as an area of support.
certainly holding within that range. What else I noticed here just while you were talking was, excuse the sirens going off. I don't know if you can hear that, but
No
one
problem.
other thing that I noticed is that you can see that we haven't even made a lower low um, relative to these lows from earlier in the summer, which is very different from what we were seeing on the S&P chart and some of the other sector charts. So we are still actually quite a bit higher than these lows from earlier in the summer. So definitely not as much deterioration in
Mhm.
the discretionary sector.
Absolutely. And now let's dive into some of the holdings of the consumer discretionary sector. Obviously, it's not just Tesla, although that is a large holding. Why don't you pull up CAR, which is the Avis and Budget Group car rental companies? A lot of speculation last summer and the year before about travel and entertainment and some of the reopening trade as people began traveling again. I'm
Mhm.
sure everyone who's watching this has some horror story about trying to rent a car in the last 18 months and either not being able to get a vehicle or being charged exorbitant rates. But from an absolute trend perspective, Alex, what are you seeing here for Avis?
Well, what's interesting was to me that we were back in a no-go. We were coming off the bottom here with a counter trend correction arrow, and I was looking to see what might happen at this zero line. Yesterday was a strong day, but what we're seeing is that we've been quickly rejected here, and the no-go price moved lower today, and a no-go trend continuation icon in place. So, of course, we don't like conjecture, and we don't like to even have strong opinions on why or what's driving what we can see on the charts. But there is a thought going around about how discretionary may well play catch up as a growth sector.
Mm,
And so, as a pure opportunity to perhaps take a position in a no go trend that may move lower, this was what I was looking at. We're moving up to the zero line now, we're being rejected by it. This is a relatively low risk opportunity to enter this trend to the downside.
absolutely. In recent conversations for the CMT Association's podcast, Fill the Gap, a number of our guests have been talking about the momentum factor, but also sort of what they would lean into in terms of a new regime shift, meaning that if we're just looking at the index level or even just at the sector level, we're going to miss out on a lot of differentiation in performance for individual securities. So when the market is ripping higher and we've had these long runs in a bullish cycle, it's very difficult to beat the benchmark. But what we're perhaps setting up for here is an economy where we do need to find those outperformers, and using relative strength is going to help us identify the sectors that are outperforming the benchmark index. But then we also need to dive in deeper, and this could be setting up to be more of a stock pickers market in that sense, which allows technical analysts to really shine in helping find those strong movers. So let's take a look at one more from the consumer discretionary sector. Can you pull up a chart of Home Depot? Which again, surprising, it's not all Tesla in the consumer discretionary sector. Again, strong day yesterday, still within a no-go trend. But Alex, anything that really jumps off of this chart to you?
The same that we've talked about before, in that we found support here at these lows that we saw earlier in the summer. Oscillator, though, is below zero, has been turned away by the zero line, but is rising now towards it. So we will just have to see if they can get out of these no-goes that they're in, or if they're going to continue to sort of match the rest of the market and move lower. Definitely less deterioration on these charts, but we'd like to see the oscillator certainly get back above zero before we thought there was any chance of new highs on a chart like this.
Absolutely. As always, a pleasure to review the markets and review GoNoGo charts with you, Alex. For everybody who's watching, thank you so much. If you're on YouTube, make sure you're subscribed to the StockCharts TV channel, and check out StockChartsTV.com for that on-demand app you can carry wherever you go. We also wanted to invite you to join us at the October Wealth 365 Summit. Alex and I are going to be presenting a couple of times. First presentation is Tuesday, October 11th at 11 a.m. Make sure to register for that event in the link below, and we'll see you again next week here on StockCharts TV. Take care.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.